The world's best stock pickers are legends of the investment world. They have developed the science and the art to picking winning stocks and outperform the global markets and other stock pickers. It's difficult to get right and to get right consistently. So, grab a pen and a notepad and let's talk about what I look for when picking stocks. Welcome to another episode of Money Matters. Before we dive into it, I will say that when I build portfolios for clients, it is more often than not that I use collectives such as ETFs or mutual funds. For nearly all of my clients, diversification to varying degrees is a key part of the investment strategy. Therefore, collectives make for an excellent way to create diversified portfolios that largely mimic the global markets. Stock picking is for those clients who have specific preferences or objectives and want to build in a particular strategy to their overall portfolio. To be less vague, many are seeking exceptional returns from these stocks at various stages of the market cycle. I will not be sharing any specific stock picks here like you'll see in other videos. I don't believe it's a good idea. Why? Investments and indeed stock picks are very personal to the individual investor. Everyone has their own objectives, risk appetite, capacity for loss and time horizon, to name but a few parameters. A good stock for me may be a terrible stock for you. Stock picks are also time sensitive. So by the time you see this, those stocks may be terrible picks for everyone. So be wary of getting specific tips from anyone via videos, articles, and even your best friend. However, I do have a certain set of rules that I follow when I go looking for stocks, either for myself or for my clients. So let's take a look. Good long-term prospects. I'm looking for companies with good long-term prospects, ones that I believe will continue to generate decent and increasing revenue. I'm looking to hold these stocks for years and not months, and not looking to make a quick buck. I have no hard and fast rule for the rate of increase in revenue, but I generally look for figures that are outstanding within its sector and to understand why it's delivering those figures. Profit is not always a must. A growing company can reinvest its revenue to expand its operations. Therefore, whilst its revenue is strong, its profit may be negligible. We can refer to Amazon back in the day when it grew from a humble bookstore to selling every type of product under the sun. Its revenue growth was incredible, but its profits were subdued because of its heavy reinvestment back into its expanding operations, allowing it to sell many other products. Find a reasonable price. As good as companies' growth prospects are, its share price must be reasonable. One key metric is the price to earnings ratio. It's not the be-all and end-all, but earnings is a key factor to determine the prospects of a company and its price, hence the price to earnings ratio. And to put it into context, I compare it to its peers. However, we can paint a clearer picture by studying its historical PE and see what it currently is compared with its average over the past 5 years. Even if a company has excellent prospects, it may be overpriced if everyone else thinks so too. Also, against the current, I buy when others are selling. If I can get quality stocks at a highly discounted price during times of negative sentiment, then it's an easy win and a great way to add to the portfolio. Good looking accounts. In particular, its balance sheet should be strong. This gives it the financial flexibility for growth in terms of reinvestment to scale the business or even to develop into other sectors. Having readily available capital on hand is a big advantage for a growing company. On the flip side, it also gives the company better protection from an economic downturn, being better able to weather periods of poor revenue and even losses. Furthermore, having too much debt and being over-leveraged may be a cause for concern. We've seen this recently in the Chinese real estate sector. I warned investors from certain real estate companies despite the attractive returns that were being made. I look at the total liabilities to total assets, but also how much liquidity it has available to clear its more urgent obligations, i.e., I look at its ability to easily access cash for emergencies, not too dissimilar to that of personal finances. Under the radar. Companies with a lot of eyes on them can be overpriced, or more likely to be overpriced. There are companies, very good companies, that are under the radar or in industries that are not particularly glamorous. There are bargains to be found here. Think of it as fishing in a quiet lake or river, if you like, underfished and bursting with fat fish. And as such, you really need to go looking for these companies. Stock picking can take a lot of time and requires patience. Don't just settle for the best one you can find one that you can genuinely feel confident to invest in. Stick to the fundamental rules. My investment philosophies still apply when stock picking. I still maintain a relatively diverse portfolio across different sectors and geographies. I'm not trying to find a whopper of a fish. My strategy is still to catch many fish. Related to my first point, I intend to hold these stocks for a long time. Whether I actually do is another matter, but the intention is there, and I usually do. I never take hot tips as gospel. If it's a company I've never heard of, then I'm usually too curious to let it pass by, and I will at least do some high-level research. But I'm yet to buy a stock from a hot tip. On that same note, I will take caution in picking stocks. It is never a punt or a gamble, as some people put it, but a well-calculated investment, as per the points mentioned earlier. If it's a company I don't understand, I simply won't buy it. It's not possible to understand everything, and I stick to what I know. A good investment temperament is key in holding stocks. It's not always the companies that are performing badly, but the wider economy, and we must be able to spot a good company in a bad economic cycle and restrain our fight or flight instincts. We must let the investment thesis play out and trust our initial research and judgment on that company. We must also review regularly. Every quarter is about right, and see if our portfolios are still relevant to the market conditions and relevant to our own personal objectives. Even a buy and hold strategy doesn't mean you do nothing, and reviewing your positions doesn't mean you must make changes. Overall, stock picking is a mix of science and an art. The science is following the same repeated steps to increase your chances of finding winners. The art is controlling your own actions and temperament when picking and holding these stocks. For sure, most retail investors will be better off picking collective investments such as mutual funds or ETFs to better diversify their holdings and ride the markets over the medium to long term. Many wannabe stock pickers are doomed to fail before they've even begun due to their warped investment attitude and lack of investment temperament and patience. However, if you have a strong desire to play the game of stock picking, let it only be a small proportion of your overall market investments. Build it around your standard globally diversified portfolio. In fact, benchmark your stock portfolio against it and see if you can beat it. And always be honest with yourself. Look inwards and not outwards. We cannot change the markets, but we can change ourselves as investors. Hence why this Money Matters series of videos exists. Instead of finger pointing, see how you can improve yourself as an investor, as a stock picker. Start off small and build up from there. But don't be afraid, give it a try and keep on learning. I wish you happy stock picking and all the very best. Thank you for joining me on this episode. Let me know what other topics you would like to hear about in future videos. If you like the video, hit the like button, comment and subscribe. Remember to share it. And I'll see you in the next episode of Money Matters.